65 years old with $2 million in pre-tax retirement accounts. Is it too late for Roth conversions? This is one of the questions we're going to explore in today's video. We're going through a case study of a couple age 65 with $2 million in pre-tax retirement accounts. We'll review the fact pattern and then model out a couple scenarios. If you are near or in retirement, you're not going to want to miss this. If you're new to my channel, my name is JP Geisbauer. I'm a certified public accountant, a certified financial planner professional, and this channel is dedicated to helping Americans retire smarter and live better. I release videos weekly, so if you enjoyed this content, please hit like and subscribe, and you'll be notified when the new videos are released. So let's go through the fact pattern for today's case study. Background. Husband and wife are both age 65. They've recently retired and they're living in California, a high tax state. They're both in excellent health and their life expectancy is to age 90. They've recently retired after successful careers. They want to spend all of their money safely before they pass. Finances. They have a $1.5 million house that's fully paid off. They have $100,000 in cash savings. They have $2 million in a pre-tax retirement IRA, $1 million each. They each are projected to earn $4,000 a month in Social Security at full retirement age, and they're open to Social Security maximization strategies. They will need to spend $7,000 per month to maintain their current lifestyle. They also want to earmark $15,000 a year and increase leisure spending for the first 15 years of their retirement. Leisure spending, think travel, dining, hobbies, just extra money for them to spend. They are currently in a 70-30 portfolio, and they're going to use an investment glide path. We'll talk more about that a bit later. So the questions they have: how can they maximize their spending and reduce their income taxes? Given their age and the fact that they want to spend all their money down, do Roth conversions make sense? So here are a couple observations. They're over 59 and a half, so they can draw down their retirement assets penalty-free. However, they need to consider the income tax effects of distributions from pre-tax retirement accounts. IRMA surcharges may increase if they implement the Roth conversion strategies. They are immediately eligible for Social Security, but want to look at strategies to maximize. So given that's our fact pattern, let's take a look at our case study. Okay, so here we are in our financial planning software, and the place I like to start is with the personal balance sheet. So as we discussed in our fact pattern, we've got a joint bank account that has $100,000 in it. The husband and wife both have a pre-tax retirement account of $1 million each. Then they have their home that is fully paid off, and that's currently valued at $1.5 million for a total net worth of $3.6 million. Currently, they are in a 70-30 asset allocation portfolio, meaning they have 70% equities and 30% fixed income. But for this particular client, we're going to use something called the Allocation Glidepath. And what that means is as they get older, the amount that they have allocated to equities is going to decrease. So as you can see here, this is their current age 65, age 66. They're going to have 70% in equities, as we just discussed. However, as they get older, we're going to gradually trim down the equity position. So when they hit about age 90 or the termination of the plan, they're going to have equity of about 40%. So we're going to be going from 70 down to about 40% of equities over the next 25 years or so. And the goal here is that as we trim the equity exposure, the risk of the portfolio will decrease. That way, if there's any crazy equity swings in the middle or closer to the end of their retirement plan, they won't be as affected as they would be if it started earlier. And trimming down the equity exposure is an effective way of doing this. Again, this is called the Allocation Glidepath. So under the current plan, as we can see, they are going to have 100% probability of success and end with projected ending portfolio balance of about $4.1 million, just under $4.1 million. Now you'll recall in our fact pattern, the client wants to spend all of their money, so they're not super concerned about leaving too much for anybody else afterwards. Certain situations might be different for other people, but in this particular fact pattern, this was important to them. They want to enjoy the assets that they've worked so hard for during their time in retirement. So as such, when looking at that ending balance, they're a little concerned. They're feeling like they're leaving some money on the table and want to know how they can spend more to make it work for them during their retirement. They also had questions on whether or not Roth conversions would make sense for them. So under the current plan, here are their key tax components. As you can see, because they are planning on taking Social Security age 67, they're going to be drawing down here till age 67, and then they're going to start collecting Social Security. So because their Social Security is covering the vast majority of their expenses, their withdrawals from their tax-deferred account, which is the orange section, is actually not that great until they get into their RMD years, which for them is age 73. And once they're in there, now we see the withdrawals from the tax-deferred accounts really picking up. So again, those are the different components, but this shows the the ordinary income tax bracket in which they are going to be in. And as you can see, for the most part, this isn't horrible, right? This line here, I guess that's what? Peach color or flesh color, is the start of the 22% tax bracket. So anything above this is taxed at 22%, but anything below that is taxed at the 12%. So as you can see, they're not really getting into the super high tax brackets as a result of their RMDs. But let's go ahead and see if it makes sense for them to do Roth conversions. Now, I want to take a brief conversation and talk about this term right here, the estimated terminal tax rate. Now, what this estimated terminal tax rate is the tax rate at which the people who inherit this IRA will have to pay taxes at. So typically, this is the client's children, because they'll be inheriting the IRA and then they'll have to pay taxes on it when they're forced to draw it down. So you want to consider this kind of multi-generational planning feature when you're looking at Roth conversions. Now, you'll recall in this particular situation, this client didn't want to leave any money. They wanted to spend all of their money in their lifetime. So we're going to leave this at 0 for the purpose of our model here. But I want to show you a quick experiment. So let's say their estimated terminal tax rate was 25%. So their kids are high earners, probably in a high income tax state. And that's what we'll say. We'll say it's 25%. Now, if we start doing the Roth conversions here, and I know that 12% is going to be the best because I've already done this. So we'll just go to 12%. So as you can see, by doing the Roth conversion strategies with the estimated terminal tax rate at 25%, they're going to have $196,000 more in tax-adjusted ending assets than if they didn't do the Roth conversion strategy. But remember, the clients in this particular exercise don't want to leave money to really anybody. They want to spend it all and enjoy their retirement. So let's just change this one variable. We're going to change this estimated terminal tax rate, and we're going to move it down to 0. And look what it does for the Roth conversions. It actually makes the strategy less efficient. We went from a $196,000 benefit from doing the Roth conversion to actually having less assets, a negative $143,000. That's a significant swing in the taxable assets. And all we did was change this estimated terminal tax rate. So make sure you understand that concept when you're being shown whether or not Roth conversions make sense for you. In this particular instance, it's starting to look like Roth conversions don't necessarily make sense for the clients in this particular scenario. So now that we're somewhat confident that giving this particular fact pattern, Roth conversions might not make sense, let's see how we can spend down this money so the client can actually enjoy more of it in retirement. So here are the numbers when they increased their spending from $6,000 a month to $10,000 a month. They reduced their probability of success to 61%, and they reduced their median ending portfolio to about $493,000. So significantly less than the $4.1 million we've been talking about earlier. So this is starting to look good. Now, 61% is probably a little bit too close to the bone as far as where they're thinking they want to be. So if we reduce our spending from $10,000 to $9,000 a month, which as a reminder, this is $3,000 more than they were projecting to spend a month, they'll have an 81% probability of success they'll still leave about $1.6 million in median projected ending assets. So a little bit more than they want to, but this kind of gives them an idea of where they can start spending. The sweet spot seems to be somewhere between $9,000 and $10,000 per month. This is in addition to the leisure spending we spoke about, and then the housing spending, which is on a different card. Because you'll recall, we actually started out $7,000 a month. So again, between $9,000 and $10,000 seems to be the sweet spot in this scenario. Now you'll recall, they were planning on claiming Social Security at age 67 or full retirement age. But they also wanted to see whether or not there was incentive for them to wait until age 70 to see if they could maximize. So here is the optimal Social Security strategy. And what it appears here is that age 70 definitely is worth it, because if they do age 70 and we compare these two situations, they're going to have $396,000 more in Social Security income over their lifetime than if they did the full retirement age. Now, this is primarily a function of their projected lifespan. We're projecting that they're going to live to age 90. So in this particular situation, it works for them. But you'll have to do your own analysis for your own situation to see what makes sense for you. So here on the left is our new analysis with the $6,000 a month in spending and optimizing Social Security by claiming at age 70. They have 100% probability of success, and their ending assets are going to be $4.2 million. So a little bit over $100,000 higher than the other scenario. So again, they're comfortable with that. That seems to make sense. So they are going to elect to do the delaying Social Security till age 70. But as you can see, they still have a lot more assets there than they are comfortable with. So in this screenshot here, the left-hand side shows the $9,000 a month in spending and delaying Social Security to age 70. While the right-hand side here shows the $9,000 spending a month, but claiming Social Security at age 67 or full retirement age. As you can see, the probability of success is much higher on the left-hand side. It's close to 90%, where we have an 80% probability of success over here. So again, in both of these scenarios, they're going to be able to probably increase their spending a little bit or even more, and decide to take down assets a little bit more aggressively. But remember, we started at $6,000. So again, this is 50% higher than what they were initially planning on spending. So this is a drastic improvement to what this is going to look like. So let's kind of look how this affects their taxes going forward and whether or not Roth conversions would make sense in this new scenario by delaying Social Security. You'll recall that in our earlier scenario, they were getting above this 22% tax bracket, but just by a little bit. But now, as you can see, they are never getting into the 22% tax bracket. And you might be asking yourself, well, how's that possible? Because theoretically, aren't they claiming more in Social Security? And then when the RMDs kick in, isn't that just going to push them into higher tax rates? And the reason it doesn't is because they are going to be spending more per month. They're going to be drawing down on those retirement assets more earlier on in their retirement lifespan. So as you can see here, this graph, they're taking more in the beginning. And this is kind of similar to what Roth conversions do, right? It sort of forces you to recognize the income earlier, do the Roth conversion, and then that money is tax-free. But because they are taking more out earlier and spending it, their ending balance is lower. So as a result, the RMDs that they're going to be forced to take are significantly lower than they were at the $6,000 spending level. So by increasing their spending, it has kind of like a similar effect of what Roth conversion does. It kind of smooths out their income more over their lifespan because they need to be drawing down more of their retirement assets to cover the higher monthly expenses. Okay, so to wrap things up in this particular scenario, we've got $9,000 a month spending, claiming Social Security at age 70, and they're going to have an 89% probability of success. If we do the $9,000 a month and they claim Social Security at full retirement age or age 67, it's going to be an 81% probability of success. So given this situation, it definitely looks like the client would opt for delaying Social Security and increasing their monthly expenses. So what are the takeaways from this case study? First, it's important to understand how the estimated terminal tax rate will impact the effectiveness of your Roth conversion strategy. Second, given their current age and life expectancy, waiting until age 70 to collect Social Security made economic sense. Of course, no one lives their life in a financial planning simulation, so if you feel that there could be other factors affecting the viability of Social Security in your particular situation, you may wish to make a different choice. And finally, number 3, if you want to spend all of your assets in this lifetime, you'll essentially force yourself to take withdrawals earlier in retirement. Doing so may reduce the effectiveness of Roth conversions, as you are effectively pushing more of the distributions during the earlier part of retirement, and thus reducing the size of your RMDs and related tax liability later on in life. Your retirement plan should be unique to your situation. If you'd like to speak with me about yours, use the first link in the description below to schedule a time. If you enjoyed this content, please hit like and subscribe. Thanks for watching, and I'll see you next time.